Hi, this is Pat Moorhead with Moor Insights Strategy, and we're here for another 6-5 podcast. I am broadcasting from an undisclosed location in Redmond, Washington. It's early. It's almost 6 a.m., but I'm here with my bestie, Daniel Newman, CEO of the Futurum Group. Daniel, how you doing this morning? A little bit of a different background you have there.
Yeah, I'm also in an undisclosed location, never to be disclosed into the future, but I've settled in. And when I say settled in, I mean this is the cleanest spot amidst a massive boxes, but I've finally moved. And for anybody that's been following this story, because it is top news, because everything I do is top news. I moved to Austin 19 months, 20 months ago. I was supposed to move into this house 12, 13 months ago, but you want to know what a bad supply chain looks like combined with a bad builder, you'll find my house. Now, the product ended up being okay, but let's just say a year late, but good to be here. It's good to be here with you, buddy.
Yeah, it's great to be here too. And literally, this is the highlight of my week, even though, it's early. I mean, this allows us and hopefully the listeners enjoy this as well. But we do have a great show today. And if it's your first time on the show, the 6-5, we talk 6 topics, 5 to 10 minutes each. We talk a little bit of news, but it's mostly analysis. And we also talk earnings, which is really the topic of today. And a reminder, don't take anything we say as investment advice. Consult an expert, because we are industry analysts, not equity analysts, or authorized to give investment advice. So we have a good show today. A lot of earnings, like I said. We're talking Amazon, Qualcomm, Google, AMD, Apple, Samsung. Pretty much the tech markets are a little bit in turmoil, maybe with at the exception of a couple companies. And it is funny. Meta came out with just a rockin' dividend, but we're not going to talk about them because they really don't do a whole lot of B2B. But let's dive in. We are talking Amazon. I'm going to call your number, Dan. What's going on over at the company?
Yeah, let's talk about Amazon. I mean, let me just preamble on one thing before I kind of go specifically into Amazon, because you said tech is in turmoil. And here's the weirdest thing, Pat. For the last 16 months or so, since basically November, was that 14 months ago of 2021, the tech markets have been falling precipitously.
Yeah.
And yet earnings over the first few quarters into 2022 were actually really good. Now, what happened effectively, and in my thesis on this, is that the markets actually were waiting for things to break. They knew that the inflation was too high. They knew that growth had happened too fast. And they knew that this pullback in labor and everything was going to happen. So I'm going to give you a silver linings, because a lot of these earnings we're going to talk about today are going to be pretty bad. But the silver linings, in my opinion, is the Fed. You saw this week, they slowed down the rate hike increases, which has been really what's been putting all the pressure on growth assets and tech companies. But when they start to see the break, when all these layoffs are happening, when you see earnings are getting hit, when you see inflation numbers going down, this is actually going to become a buying signal. And again, we're not giving investment advice, but if you actually look at tech, a lot of double-digit gains in tech, even though some of them fell a little after this week's results, but they were going up. And as companies were announcing layoffs, things were going up. And as companies were announcing weaker than expected sales, their stocks were going up.
Well, I know actually the NASDAQ, over the past month is up 17%. So,
right. And all I'm saying is, yet we all knew it was shit. I mean, we knew that it was actually going to be bad, and yet the markets are going up. And like last year at the same time, when things were really good, you and I were like, what's going on? Good earnings, and the stocks are falling. So Amazon basically came out with better than expected revenue numbers. And in my take, that kind of has to do with a couple of things. When I'm only going to talk about commerce a little bit, and then I want to talk more about AWS, because I think that's really where we tend to have a lot of focus, Pat. But the revenue beat somewhat significantly. Now remember, this company did $150 billion in revenue in one quarter. Pretty good number. But its growth slowed down. I think it's one of its slowest growth quarters ever, if not slowest ever. In high single digits, which they also posted a lower earnings number. But let's be candid, with the Rivian factors and stuff, it is extremely hard to discern how Amazon reports EPS. So I'm gonna stay away from that part. But the revenue numbers were really interesting because they were up, and they were actually better than everyone expected. but the guide was down, and they guided to like a mid-single-digit growth next quarter, which is unprecedented for Amazon.
Are you talking Amazon or AWS?
I'm talking Amazon right
Okay.
now. We'll get to AWS because they were a little better than that, but the Amazon was they're guiding towards about a 4 to 8% growth, which is just like unheard of for this company. That's their overall number.
Mm-hmm.
Now, the interesting thing is you're still talking about them doing something like $125 billion in the next quarter. So, the demand for their e-commerce and their products and their services is still really substantial, but we do have slowing demand. Now, we got to look at the external macro factors here. Is household balance sheets have been in incredibly good shape all the way through this pandemic. All the free money that went out, people were propped up, the strong labor market, and then the asset bubble, people had more access to capital than ever before. So what's happening now is you're starting to see with interest rates rise, with inflation numbers high, home balance sheets got weaker. When home balance sheets get weaker, people spend less on non-commodity items, on discretionary. So that's going to obviously hit Amazon and its core e-commerce business. A couple other areas, though, that were good for Amazon was their advertising business, which is really interesting. I know Google's under a lot of pressure with their ad business right now, regulatory, and of course what Microsoft is doing. We'll talk more about that later. But they grew almost 20% on advertising, and with Google's numbers on advertising itself being single-digit growth this quarter, that means Amazon's actually gaining share in advertising, which has a lot to do with targeting the commerce and the buyer rather than through a more traditional search modality. So that number looked really good. The only other number that I want to bring up, and I'm going to kind of just touch on it and hand it to you so you have something here to talk about, Pat, is the AWS number. Google and Azure were both in that low 30% range, and Amazon's AWS came in at 20. And so I had a lot of inquiries from the press and the media. And I just think it's really important to basically say the size of the AWS business and the law of large numbers. If you look at the actual revenue growth when you're growing at 20% on their business, they're $21.4 billion business right now on a quarterly. That's tracking to almost $85 billion, is immense. As we have seen enterprises pull back, slowed spending, looking for, I've talked a lot about deflationary tech, maximizing their current investments, meaning some workloads maybe not going to the cloud as fast as they are. That's going to put some pressure on AWS, but the size of that business is immense. And growing 20% in what's considered to be a horrible economy is still pretty good. They're going to have their work to do as they try to, take that to a $100 billion annual business. But I think it's being a little overblown. And 20% growth in a business of this size with that level of profitability is still a pretty great result.
Yeah, and just to put stuff in perspective, so overall, they missed on the guide by 1.6% on revenue. Where they got clobbered was on profit, right? They guided to almost a 45% lower operating margin. I think that's where a lot of this reaction is coming from. And I got a lot of inquiry as well on that AWS number. And it was interesting. I talked on the call, and Andy Jassy kind of dissed the competitors, which he said, we're the only one who actually has a true cloud number. Now, there's a certain element of truth to that, but there's also a certain element of I don't know what. AWS number includes SaaS as well. AWS number has SaaS included in IaaS. I don't see the definition of cloud as just IaaS. Let's just call it that. But what is true is that Amazon's percentage of cloud is very heavily tilted to IaaS, where Google is a combination of IaaS plus Google Workspace. And then even Microsoft and their numbers, the Azure number is not straight Azure. It's also includes services to its own PaaS services like Dynamics 365. So totally get that. But with that said, it makes sense for me that the others would be about 10% clip higher on growth, and Amazon is not at that 20%. I guess what I'm expecting as well as we get into the Dells, the HPEs, and the Ciscos, I would expect them to decline because those are the closest competitors with IaaS, which is on-prem. It is interesting. Andy also, like I know the guy I don't, but Andy made the comment about how customers, he can totally see how they would be pulling back a little bit. Amazon internally is pulling back as well. Like maybe they wouldn't crunch numbers as long, right? That was an example that he used. But I think the best thing that he did on the call was talk about innovation and how he has these big bets that some come through, some don't, which I thought was very, very solid and very, very true. There's nothing wrong with Amazon. It is entirely based on the economy. I think they would be doing better if they sold a higher percentage of, let's say, food, because people are not going to stop buying food, right? Grocery stores are not, declining. People have to eat. They're not going to make their own food, and they're not going to starve. So this is just showing the tilting and the mix to more hard goods, things like that. So Dan, let's move into Qualcomm, and I'm going to call my own number on this one. Qualcomm had what I consider something that I think everybody expected, right? The market is down for smartphones between 15 and 20%, and Qualcomm is down by even a little bit less than that. So they missed on the revenue side, but they beat on the EPS side. But it's really the guide that matters in the future. That was down around 7% on the revenue side and 7% on EPS. No question here that this is 100% the macro market. And if you also look at, I would say, their biggest strategic element, which is their diversification, automotive and IoT, automotive and IoT are still looking really, really good. IoT took a little bit of a hit, and what I'm hearing is that is primarily an inventory adjustment out there on the consumer side, where people are buying less items with Bluetooth as an example, low energy Bluetooth. But automotive is frickin' rocking, right? When you look at that number, I think it was up almost 50%. So kind of chewing into that. What is the number now, Daniel? $11 billion.
Their pipeline?
Yeah.
30.
Oh, sorry, 30.
Yeah, and Nvidia is 11, but remember it was an $11 billion growth, I think, in one quarter. But yeah, that was a number that was thrown around, Pat, 11.
Yeah. Anyways, I'm not concerned at all about the quarter. I mean, it's basically tracking to what the market is doing, and we got to be honest. I mean, Android is losing a little bit of share in premium to Apple, so that number is actually a little bit more than that. But inventory and handsets had a lot to do with the quarter, and they're modulating OpEx as you would expect.
Yeah, I think it was a fairly straightforward and expected set of results. We both had the opportunity to talk to CEO Cristiano Amon, and appreciated him and both at Akasha, their CFO's time yesterday to kind of run us through some things. The read between the lines is, this inventory drawdown's taking longer than everyone expected. I think it was going to be a quarter, and it's 2, and now it's looking like it's actually going to be about a 3-quarter drawdown. And these are some of those macro effects of the economy that you and I are talking about. You're seeing it now. This means what it means is weaker demand. I mean, I had some interesting questions from the press about, why like certain semiconductor companies like Silicon Labs had really good performance in retail this quarter, right? And then why are the client numbers so bad from everyone? I mean, because even AMD, which had a good quarter, we'll talk about that, their client numbers were really rough around devices. And I mean, it all had to do with how the channels and how their inventory got loaded up during the pandemic when things were scarce. Everybody bought everything they could get. So when supply became available, they loaded up on supply. And then when the demand cutoff happened somewhat precipitously, they got stuck with a lot of inventory. And so now they're all burning through inventory. So you may even see some better numbers from some device makers and OEMs on all sides because they're able to draw down inventory. So you got to kind of watch the inventory numbers against the sales numbers to see if, in fact, how sales are going versus how backlog is being managed and being fulfilled. But for Qualcomm, I mean, their story on handsets has been that they're aware that it's a very important part of their business, but diversifying is more important. Almost 60% growth in automotive, although a small part of their business, is very indicative that $30 billion pipeline is ramping. And so when we were at that automotive investor day, Pat, you and I were in New York, you could sense the energy moving in that direction. And by the way, the automotive industry hasn't been hit the same way devices and PCs because they've never gotten to a point where their supply is caught up. I mean, you can still see car dealerships that have lacking inventory. So, the IoT business slowed down a little bit. And of course, the way they're embedding the RFFE into all the numbers now, as opposed to tracking that separately, is an area to watch. Pat, one other area I think you and I will really be keeping an eye on over the next year is going to be the PC business, which they have embedded in the IoT business, which I asked them about. And I think that's going to be a number that sooner than later, we're going to want to see more call out and more specifics on. But they've got some very interesting technology through the Nuvia acquisition, a company you advised closely, a company that we're all eager to see what comes from. But I think there's a big bet going on there too, as a part of their diversification strategy. It's going to be a tough market to enter, but Qualcomm's strength in mobile could very well be an enabler for them to have some strength in that business in time. But you hit a lot of it on the head, so let's keep rocking and rolling, buddy.
Yeah, let's move forward here. And just a note on inventory, it's always important to, when it comes to chip makers, to contemplate there's two elements of inventory. There's the chip inventory, and then there's the device inventory. And when you have the device makers, the PC makers, the phone makers, whatever makers, IoT makers, they because there was so much oversupply, they have to not only burn through that, but they have to burn through the chip supply that they were sitting on, because some of them were double ordering as well to get through some of the soft periods. So let's move on to Google. Dan, what's going on over there?
So this one I've spent a little bit more time with Pat. I joined Bloomberg yesterday, and new hosts, by the way, on technology. So
oh, wow.
Yeah, after a long time, Emily Chang moved on, and now you have Carolyn Hyde and Ed Ludlow. It's kind of different, back to the old days of two hosts on different coasts. Hey, look at that, hosts on different coasts. I like that.
How about you? You're always
I'm going to use that one. But no, it was really pretty much a miss across the board for Alphabet. Missed on earnings, missed on revenue, missed on YouTube, missed on cloud, and they saved a little bit on traffic acquisition costs. So 1% growth for Google, 1% growth. Now, again, you can look at this two ways. 1% growth over what was like record growth numbers that happened all the way throughout the pandemic to a slowing period where they're flattening out. Or you can look at it as, the world is ending. Alphabet's growth has slowed down. So look, advertising, I don't think is as much your and I's sweet spot. But what I'll say is you got to kind of look at the macro environment. I still think Google is above the fold. It's one of the most important search engines for any company that's looking to drive traffic and drive digital foot traffic into their various commerce platforms. And so I don't see it as a huge problem, but I think in times a weaker economy is always going to pull back on advertising. So there is some preference moving around. Google is under a bit of scrutiny with the FTC, and that's going to continue to be the case. I think it's interesting timing now with ChatGPT, OpenAI, and of course, Apple and Amazon all growing in advertising. If Google's really as big of a problem, but Lena Khan needs a win somewhere. So, maybe this is the one she thinks she can get. So far, not so good for her. But overall, Pat, I think a couple of subplots is the macro is going to be tough. The company's doing layoffs right now. And again, it's important perspective, though, is they're laying off about 12,000 people, but I still think they're up like significantly from a year ago. So they are laying some people off. They are looking to reduce some costs. They are trying to pull back on some real estate. So they're doing the OpEx thing. right now, the street wants to hear companies pulling back, spending less. Those are important things, and I don't think that's going to change anytime soon. I want to flip over a little bit, though, to Google Cloud. So narrowing losses and 32% growth. So is that enough? And that's a big question. So the big bets, Thomas Kurian and team, is that Google Cloud has to be a big part of its future. And the growth rate is good, but they're still not showing profitability. I think they're committed, though, Pat. I think they're committed to not making money until they hit an economy of scale where they can truly compete. I don't think Google gets into the cloud business to be a distant third to Microsoft and Amazon. They're going to keep going and growing until they hit that size and hit that scale, hit that capacity. And that's where probably the last thing notable is a lot of talk yesterday about Google's AI plans. They're changing the reporting. They're going to start breaking out things like with DeepMind and the revenues and the business much more closely so people understand its AI strategy. And let's be very clear, this has been driven by the recent moves by Microsoft. Microsoft's investment in OpenAI and its very, very aggressive implementations of Chat GPT-3 and the rest of OpenAI across its portfolio, and the expectations of doing that is going to force Google to come out of its somewhat hibernate state about what it's going to do with AI. And we are going to hear soon. And Pat, I think Google has some things up its sleeve. Google has been working for a long time to be the leader in AI. Its cloud business has been built a lot and functionally on the AI technologies and the data and the ML services that it offers. You see a lot of intelligence built into Workspace to Google. And of course, amazing amounts of data in its search business. I think the company has more to offer. And I think for the world, giving OpenAI a challenger is going to be a good thing. I think we need challengers. Nobody can just run away with it now. But now that Microsoft's gone all in, I think we're going to see what Google's got in its hand.
Yeah, Dan, if you recall the last 3 times we talked about OpenAI and Chat GTP or GPT, I always mess that up. GPT. I brought up Google, and I absolutely knew that Google had something going on. And in fact, Sundar announced an event that's going to be on the 8th next week to go through what they're doing in search and beyond. And one of the key quotes Sundar opened with was all about long-term investments in computer science. We're well positioned to be in AI. It's reached an inflection point, and we're gonna be there. And yeah, that was an absolute reaction to what Microsoft is doing with OpenAI, but absolutely reinforces, my prognosis that Google is working on something. They have been working on something. DeepMind has been out there for forever, and we're going to have to see on the 8th what they do. On advertising, it is funny. I was surprised advertising didn't crater last quarter. I couldn't understand how that number was so good. And the only thing I can come up with were longer term ad buys. It took a little bit longer to turn the spigot off the marketing folks than it normally took. And then, finally, I don't have much to add on the Google Cloud part. I mean, the growth is really good. The narrowing of the loss is exceptional, and it was a good number. And I'd love to see the breakout of IaaS versus PaaS and SaaS, but that's not going to happen. I was also happy to see Sundar talk. He's been talking more about Google Cloud on the earnings call, which I think is important to enterprises to send the message that this is a business that is important to Google. If nothing else, it just shows that Google would be better off by having a much bigger B2B business than the B2C or advertising business. I mean, look at the numbers. Search, YouTube, network, all down. The only thing up was Google Cloud. Sure, other bets was up, but I don't even count that. So the one final thing that I think could have some reverberations across the industry, again, we normally don't talk about depreciation changes, but Google changed their server and network depreciation from, I think, 5 years to 6 years, and extending the investment. And I'm wondering what impact that has to the chip makers coming forward. It's good stuff. Let's move to another chip maker, and that is AMD. So everybody was wondering, what was AMD going to do after what happened to Intel? I was actually able to go on CNBC on Monday morning, give my prognosis before the earnings, and I am happy to say that I pretty much nailed it. The reason that AMD's earnings were really good, a couple reasons here. First off, the company's very diversified with their Xilinx acquisition, which, if you recall, that was probably half of the thesis behind that. The other half, beyond diversification, was the ability to get more into AI. But if you look at the way that their business is laid out from a revenue perspective, this added about 25% at least to revenue, but it added a heck of a lot more related to operating income dollars. So it's doing exactly what it was supposed to do. When they made the first overture to buy them, nobody thought that was a requirement, but I think AMD is looking really smart right now. I also think that AMD on the data center side is taking unit and revenue share. That business was up 42%. And the sweet spot, right? And we know from Intel that the enterprise data center, they're dialing down the knobs on that at a quicker rate than the cloud. But AMD's business there is $1.7 billion. Client, the PC business is exactly what you would have expected, down kind of an eye-watering 51% year over year. A lot of inventory challenges here. I think the good news is that AMD and Lisa Su is not going after headhunting related to unit share. I do expect them to gain revenue share this quarter, but I expect them to lose unit share. There's a lot of debate out there as exactly what happens, and the wild card is these inventory pieces. Gaming, you would expect down 7%, primarily driven by the softness in PC gaming, and also a little bit to do with consoles. So all in all, a pretty good quarter for AMD, and I think there's a lot of reasons why it's doing better than a lot of the higher performance chip companies out there.
Yeah, Pat, you hit a lot of it here. AMD did have a remarkably better result than Intel, and I think that was where a lot of positivity came in. That has been a bit of the AMD situation for the last part of a couple of years now, where that's been kind of how they've been benchmarked. I mean, look, everything though that is going on in the economy kind of resonated through in their numbers. The client business was really tough. They had a big benefit from Xilinx and being accretive, 1,800% growth in their part of their business because of that. The data center number was a little bit of a surprise, but I don't know if that was a surprise up or if Intel's number was a surprise down to me, because as I kind of processed it, I really expected the Sapphire Rapids ramp to have given us a bit more surprise to the upside last quarter.
Great.
And that came in way softer than I expected. And does that mean that these strong numbers from AMD had to do with AMD taking more share? Did it have to do with not fulfilling orders? I mean, what was the exact situation that led to AMD's really relatively strong growth, given that you saw hyperscaler numbers? They're not particularly huge growth this quarter. And so AMD getting a lot, is that enterprise spend?
Well, when you're taking share, right? So
Yeah.
AMD is about 20% share to Intel's 80. So
Yeah.
the market might go down, but you still have the opportunity to take share there.
Well, and that's, you and I have always said, market taking is something that's always a bit more opportunistic. When in tougher economies, companies that are market takers have a little bit, less stress to find growth. It's kind of like Dell every quarter with its infrastructure numbers. When you're number one in like every category, you are always seeding TAM if you're not growing. That's all that means. It's very straightforward. Some of the numbers like in consoles, Pat, I believe they record console numbers at AMD this quarter. Did I read that right?
I don't pay enough attention to that, Daniel. I'm gonna claim
I think I saw that. I read that somewhere, so I'm going to double check that because I hate giving inaccuracies. But I think I saw something. There were some really strong numbers in consoles, I think overall though, Pat, it was a strong quarter, and AMD's just doing a lot of things right. I mean, it's all it comes down to is they're doing a lot of things right and they're being opportunistic, which sometimes that's one of the best ways a business builds a foundation is when someone opens a door for you, you run through it. And Lisa Su and the team have been consistently doing that for the last several quarters. This was a good result. And Pat, you wrote a great article about Intel's future this week on Forbes. And I just want to say that anything we're saying here is not indicative of the fact that we don't think Intel has the chance to come back. They're 4-3 plan. IDM 2.0, if they can execute, I still don't call it I don't call it an end of days. You said the words before, 80% market share in servers still today. But when you are on top, the pressure is immense. And what needs to happen for Intel is really, there's no more talking about your plans. It's just doing it. And if they do it, they have every opportunity. They have all the right customers. They've got all the right channels, but they need to deliver. And so we'll be watching that really closely. So speaking of watching closely, Pat, I know you and I go back and forth on how much we want to talk about Apple.
Are you the host this week? Yeah.
Oh, oops. Hold on. Go back.
Yeah. So
Kick me in, Scotty.
I want to close out AMD. I went and you brought up my Intel piece. It's been read 577,000 times on Forbes. Like I had no idea that it would get that big, and all I did is point out potential for Intel. It doesn't make me an Intel lover and an AMD hater, but net what the company has done is first of all completely radical architectures. Right? They were doing distributed before distributed was cool. They did it before Intel. And they did it before NVIDIA. The second thing is they were able to leverage TSMC. That's just absolutely rocking out there, and their expenses are way low, right? I mean, they came a couple months of running out of cash, and they cut a lot of people, including me, high-priced corporate executives. So, but none of this means that Intel can't have a turnaround. Quite frankly, AMD can still succeed even if Intel does, because they have Xilinx right now. But let us move to the next topic, because I am the greatest show host out there. Let's move to Apple.
I was so going in hot there, man. I had a great, that.
Sorry, buddy. Sorry, man.
I wanted to get in my. Guy. I'm not.
All I wanted to do was do a victory lap on the amount of views that I got.
Dude, that is remarkable. Organic traffic.
There's no promotion on that post.
I have written for Forbes for almost 6 years, and I don't think I've had that much traffic in a month. So all my posts together, and I write some really amazing stuff, by the way.
You really do.
But if you do want the best commentary on what's going on earnings, check out my Market Watch columns, because I'm breaking down everything and what all this means. And because, I never miss a chance to beat my chest, but I like to beat your chest too. I hope that never gets recorded out of context. Yeah. Anyway, so let's talk about Apple.
You just get that.
Pat, Apple's sales, they declined on a year-over-year basis. Is Tim Cook on the chopping block? Is this the end? No, I'm kidding. Sensational, right? Sensational.
It is fun. It is fun to say, though, right?
They saw 5.5%. Well, if he took my calls on earnings day, I wouldn't be so upset about it. All the other CEOs call us. I mean, why doesn't
call is right? What's
Tim
wrong with
Apple
that
never
guy?
calls?
I know.
And but they were down 5.5%. They missed by $4 billion. Now, when you're at 117 versus 121, I guess you could say that's a small miss, but that's substantial. And it marks the first in a long, long time. I think it's like since the mid 2010s. So it was the last time they had a deceleration or a shrinking of revenue year on year. Their earnings also fell year on year. iPhone revenue missed. Mac revenue missed. Other product revenue missed. Services revenue did beat just ever so slightly, and so did margin, by the way. So margin was okay. iPads were hot this quarter. Now, I have no idea what to attribute that to. Here's what I would attribute it to: bad analyst forecasting. Because not only did they hit it, they beat it by like a ton. Where does that come from? I guess maybe iPads were a big Christmas present this year, a big holiday gift. You know what I mean? Like, that's the only thing I can attribute it to. But otherwise, it was a total stinker. Now, let's just be candid. I think the quarter before they were a lot better than everyone had expected, and so they kind of came into last quarter kind of warning that this was going to be weak in their earnings, and I think no one believed them because the quarter before they warned. And I think it's like you kind of said, Pat, about Google. Like, you were just surprised it took this long to get bad.
Yeah.
The difficulties of the economy are actually finally starting to show. And that's where I started this whole conversation about something had to break. I candidly, as much as I like to sometimes pick on Apple, I don't know that this is anything really to do with Apple. China, of course, is always going to be a factor, and the fact that China has not completely opened up, shopping has not returned to normal. By the way, it doesn't only affect Apple, but it disproportionately affects Apple.
Yeah.
Getting back to that particular market in full strength will be a big help to the company. But let me talk about what Apple has going for it, Pat, and that's going to be on services and advertising. Apple has shut down the advertising market to companies like Facebook and Meta. And that's what I said earlier. I think I said yesterday to Bloomberg, I said, yeah, it's great that their policy, they're going after Google. I said, but really who they need to be looking at right now is Apple. I said Apple for two reasons. One is its App Store stuff is the most of any anti-competitive practices in the market today that I've seen as Apple and its App Store. But what they did to advertising to basically knee chop its biggest competition, especially Meta, to me only shows that these moves towards content, these moves towards services, I just feel like, there's a wolf in sheep's clothing here in terms of Apple and what it plans to do with advertising. And Cook kind of alluded to it when he talked about the captive iPhone audience that's going to be able to be delivered services to, and the long-term opportunity that creates. Because everybody looks at the iPhone number. iPhone number's bad, Apple sell. That's not Apple's future. I mean, there's always going to be iPhones, and they already have such a strong position in that market, Pat. But the services and every dollar that it can add in terms of spend per user is going to be monumental. And the company just continues to turn the screws there. So not a great result for Apple. I don't think it's necessarily indicative that Apple has any long-term worries that are going to be more substantial than whatever the macro environment puts on it. But I will say, Pat, that it's kind of fun to see them fall every once in a while, because it felt like maybe they were above any pain where the rest of tech hasn't been able to rise above. But long-term, Apple is a bellwether, and ultimately we always want the economy to do well.
Yeah, it's funny. Tim Cook led with disruptions in its China factory, where they were allowing their workers to get beat with metal poles, which just doesn't seem very aligned with the brand. But the thing that I focused on here was that Mac number, right, off 29%, and that I don't think was unit related, because both Canalys and IDC had them down 1%. So, and then I see kind of the deals they're doing with Best Buy, where they're, getting $100, $200, $300 off. The two big consumer brands out there on the premium side are Apple and Surface. And Surface was down 39%, Mac was down 29%, and both these companies were taking just gigantic swings at prices. I am wondering if the huge price cuts will make an overall brand impact. I doubt if it's in the short term, but if Apple keeps cutting prices on its Macs, it very well could see some brand dilution. Which, by the way, if you look at the value of the entire company, brand is I would say its largest value. Its products are good. In some areas, they're even better. I don't give them a ton of credit on the Mac side. I do give them a ton of credit though on the watch side, and their AirPods are the best product out there. But when it comes to phones and Macs, they're really not that differentiated, aside from maybe the benchmark performance that the Macs get today. So interesting market, interesting to see Apple. Apple, is never done. They're never dead. Competitors don't have Apple right where they want. But I am very intrigued though about what Microsoft has up its sleeve, and quite frankly, Google, related to these LLMs and their capability. This is not an area that Apple is strong at, right? Apple is strong on the client side, and they pretty much get zero respect for anything that's done in the cloud. So let's move on to the final topic. Thank you for letting me, Dan, move this thing forward. I do appreciate that. Samsung Galaxy Unpacked. I spent the first 3 days of the week in San Francisco, just basking in all of the love that was there. Met with a ton of Samsung execs out of Korea, and that was the first time in 2.5-3 years that I'd spent an inordinate amount of time with them. Two main themes here: new Samsung Galaxy S23 and the derivatives, and also a new Ultra line of PCs. So what's the one thing you can always expect at any premium smartphone launch? A focus on the camera. And it's important to end users. It's one of the main purchase drivers. And I'll be honest, from both vendors, Apple and Samsung, it's been a little bit of a yawner for me, but this one got me really, really excited. Okay, the 200 megapixel sensor, the improved, in particular, the AI algorithms. What they did for analysts, certain analysts this round, is they let us try the products before the event. And it wasn't some big mad rush afterwards when you're having to fight with a bunch of YouTubers to get in and actually use it. But they had this really thoughtful 3-story building in downtown San Francisco where you were able to use the S23 in different lighting conditions, different focus conditions. And Dan, it was kind of freaky how good the algorithms are when you get even to 100x zoom, and how it used to be pretty jagged. And by the way, miraculous, you could do 100x. But what happens now is AI comes in and then aligns all the pixels where it gets us closer to the DSLR capabilities. The remastering capabilities, particularly when it's coupled with that 200 megapixel sensor, is pretty wild. And remastering says, okay, I took it, 3x4, 200 megapixel. You take a picture. If you want to make it look better, you press a remaster button. You wait about 15 seconds, and literally it's applying all of these AI techniques. So really, really cool there. The second big announcement was the Samsung Galaxy Book 3. And I've always asked, hey, is Samsung actually serious about the PC market? It seems like they could do pretty well in it. They make a lot of the silicon themselves. They make the displays themselves, and there is the ability to go in and take share, and their channel strength, right? If you look at dishwashers, frickin' fridges, TVs, right? They carry weight inside of retail, the Best Buys, the Costco's, the Dixons of the world out there. So that's what they have going for it. But I just wondering why they didn't put the pedal to the metal. But the Ultra is a beautiful device. I'm told that I have one on its way. It looks kind of design-wise, kind of close to a MacBook Pro, with Windows and an Intel processor. But Dana, the demos of this 2x AMOLED display were absolutely stunning, particularly for content. And that was another one of these vignettes that they had in their experience center that I was pretty motivated about. I want to end on what I think was the third biggest story coming out of this. And this was the trifecta of vendors that TMRO put up there at the literally at the end. And, where do you put your most important things you want to talk about? You put them at the front and you put them in the end. So TMRO brought Cristiano Amon and Hiroshi, who runs Android for Google, up on stage to announce an XR alignment. But what he did before that is he allowed Cristiano Amon 3 minutes. Well, first of all, TMRO said the Snapdragon processor was the absolute highest quality, most efficient processor out there. Kind of puts Exynos's future. You gotta absolutely question that. But announced there was a specialized processor called the Snapdragon 8 Gen 2 for Galaxy. And what I can surmise is it's a frequency and probably a voltage boost on that, but what I would call a semi-custom processor. But they gave Cristiano Amon 3 minutes to talk about the processor, talk about the NPU, talk about the Wi-Fi, and the strategic alignment that the two companies have. And it was great to see what was announced, I think, in the fourth quarter of last year was the strategic alignment between the two companies, but this actually made it real, right? The Snapdragon 8 Gen 2 for Galaxy, right? That is the brand of the processor, plus the alignment on the future investments in XR with Google. So a lot of words there. Hopefully I left you something there, Dan. You always manage to come up with something.
Well, you might have accomplished for the first time, leaving me legitimately nothing to add. I guess the only thing I'll say is read between the lines, people. The heads of Samsung coming up and basically saying better with Qualcomm is probably the most clear signal I've ever seen that their future revolves around that partnership being deeper, and that Exynos's long-term future is definitely in jeopardy right now. Apple, we talk a lot about. There's a reason Apple hasn't gone away from Qualcomm yet. There's a reason Samsung's leaning into Qualcomm. Sometimes it's just gets it right, and it gets the right fit for the market long term. So I didn't attend Samsung Unpacked, Pat, but I do continue to be impressed with the innovation. I use both an Apple and a Samsung device. I look forward to seeing the S23 land on my door, and I look forward to playing with it. But no, I think that was a good way to wrap, Pat, and I think you hit it all on the head.
Hey, one final question for you is, I was thinking about the ramifications of the downturn. You have some companies in China. You have the Google Pixel folks who are doing their own custom SoCs, and I'm just wondering, how do you explain to senior management that you're spending, $200, $300, $400 million on a custom SoC when Qualcomm will make you a specialized processor for the right terms? It seems like that would be upside for Qualcomm, I think upside for Intel, and upside for AMD, and maybe NVIDIA. Just a thought, but I don't know if you have any thoughts on that, Dan, at all.
You can go across every industry, Pat, and say that there's a little bit of a desire to build homegrown silicon to be able to feed the machine and I guess over time maybe lower OpEx and drive some differentiation. But at the same time, to your point, is if it can be still function and act like that, and you don't actually have to do all the heavy lifting, which some of that, we've seen what ARM does with its instruction sets and being able to enable that in, like, say, the cloud for companies. But Pat, it's a great question. And if this Samsung thing really takes off and is a success, there's going to be a lot of people answering that question to their bosses as to why they're spending, like you said, hundreds of millions or billions of dollars to try to build something from scratch when they could have something unique built for them. But sometimes there's a race to the top, Pat, and sometimes it's a race to the bottom. So
yeah, just from a volume standpoint, let's just assume let's put a $300 million number, and that's not a grounds up CPU. That would be more like a 500, 750. But let's just say a custom SoC, 300 million, you're doing 1 million units a year for that line, 2 million units for that line. You better be doing 20, 30, 50, right? To be able to make that payoff. And it's not a one-time investment. It's every time you want to open up that SoC, make some pretty big changes, that is what you're going to be doing. A lot of the expense is not necessarily in design, but it's in validation and test and getting down to the very end of it. But I think interestingly enough, for the biggest chip makers, I think they should be going in and having discussions at the highest levels of the companies doing their own custom silicon, saying, "Sure, you want to do this? Maybe we can do something custom for you." I mean, heck, Marvell, AMD, and even Samsung have some pretty sophisticated custom capabilities. I've been kind of surprised to see that again, it's really a frequency and a voltage difference. That's a big deal for even Qualcomm doing something a little bit different. Anyways, Dan, it was great to see you, buddy. Any final comment?
No, I was just saying your suggestion is maybe a Google or Microsoft driven chat GPT response. It's a little bit like an ATM at 3 a.m. When someone tries to do their ground up silicon, it should ask you the question, are you sure you want to do this? Kind of like withdrawing money at 3 a.m. Chances are the answer is no.
Made a lot of sense when the market was blowing and going, but you got to ask these questions. I know downturns in every big company I work for, all the stuff you thought was untouchable suddenly becomes touchable, and ask questions. Dan, it was great to see you this morning. You're in a new house. You need to get I need to come over and put some books up on your shelf back there, maybe some pretty flowers. But I'm spending the rest of the day in an undisclosed location in Redmond, Washington. Be back in Austin around midnight. Can you make sure all the ice is melted and I have, a good entryway to come into?
I'll call my guy.
Thanks. Call your dad too while you're at it. Thanks, buddy. I want to thank everybody for tuning in. If you like what you heard, hit that subscribe button. If you have comments for Dan and I, you know where to find us on social media. We spend way too much time on there. We appreciate you. Have a great weekend. Take care.